Most real estate investments and development projects are financed with two different parts of the capital stack, both equity and debt, and with that comes job opportunities on both sides of the business. For real estate professionals, each of these industry disciplines provides a very different experience and will equip you with very different skill sets and exit opportunities when you're ready to move on. And if you're just starting out in the industry, knowing this up front is really important since your overall career trajectory can be heavily dictated by the track you start out on. So to help you get more clarity on which part of the industry might be right for you, in this video, I want to talk through some of the biggest differences between the debt and equity sides of the business, some pros and cons of each of these paths, and where you might fit in best based on your long-term goals and where you're looking to end up in the future. So let's start this video out on the equity side of the equation first, and let's talk about the pros of starting out on this path and some reasons why you might want to pursue this route when starting your career. And in my experience, the number one reason that people tend to choose equity roles over positions on the debt side of the business is that by working for an investment or development firm directly, you tend to get significantly more training on detailed real estate investment analysis and creating underwriting assumptions that drive investment decisions. And you also get a much deeper understanding of the equity return metrics that are being looked at most by investors on a deal. For people who want to go out on their own in the future, whether that means investing in small deals on the side of their full-time job, raising equity to put together syndications and buy bigger deals with partners, or even raising discretionary funds and building large operating companies, one of the biggest appeals of working on the principal side of the industry is that in many roles, you're essentially getting paid to learn what this process looks like and what equity investors are looking for when evaluating investment opportunities. Being on the equity side of the business also gives you much more in-depth exposure to the equity raising process itself, which tends to be one of the most difficult parts of real estate entrepreneurship, and you'll also get an inside look into how JV partnership structures operate and how equity waterfall structures are used to split cash flows between investors. Being on the equity side of the business also gives you significantly more exposure to operations and how a property might actually perform over time, and will also often get you involved with things like construction management or commercial leasing that you just wouldn't be on the front lines with when working for a lender. If you want to learn how to do your own deals, how to make underwriting assumptions, or how to raise capital and get equity partners to invest in a given project, working for an investment or development firm will usually be the most direct way to get that exposure, and these are some of the biggest pros of going the equity route. But moving on to the downsides, one of the biggest cons of working on the equity side of the business, which many real estate professionals have experienced firsthand over the last 12 months as rates have risen and deals have gotten scrapped, is that these jobs tend to be a little bit more volatile, with good years often being great financially, but lean years often involving significantly smaller paychecks and a much higher probability that you might end up losing your job. Working for an investment or development firm also tends to require you to become an expert in only one or maybe two commercial real estate product types, and likely just a small handful of geographic markets as well, which can be a major downside for young professionals who are new to the industry and relatively unsure about which product type they want to focus on, or even which city they want to live in long term. Coming from an equity background, your viewpoint on deals is also going to be primarily centered around the equity returns those deals can generate, and beyond seeing loan terms in a term sheet or in loan docs directly and then plugging these into a pre-built financial model, you really won't know the inner workings of how a lender operates and how they're going to view a given deal you might send them. Overall, if you're looking to learn how to analyze your own investments, you have a good idea of which product types and geographic markets you want to focus on, and you want to build your own real estate investment or development firm in the future, the equity side of the business could be a great part of the industry to pursue. But if you're not comfortable with potential fluctuations in your income, a high degree of volatility in job security, and you want exposure to multiple different asset classes and potentially different geographic markets as well, you may want to consider the debt side of the business, which we'll talk about next. And on the debt side of the equation, let's start with the pros of going this route. And the first benefit that many people gravitate towards, especially when working for traditional lenders like insurance companies or banks, is that there tends to be a slightly lower level of risk and lower volatility as far as career stability is concerned. And you'll also usually see smaller fluctuations in income during down years in the market. This is usually true even in mortgage brokerage, where commission checks tend to be slightly smaller than what you'd see in investment sales, but also tend to come in more frequently, with commercial properties often being financed 2 to 3 times or more for every one time a property is sold. And unlike most equity side roles, working in debt will also often expose you to a variety of different real estate asset classes across a variety of different geographic markets. So if you're unsure about where you want to focus your efforts in the industry, and you want to learn a little bit about multiple different product types before committing to an industry sector, a role on the debt side of the business can often help you pinpoint where you want to specialize over the long term. Debt side positions also give you an inside look into how lenders look at deals and the behind the scenes conversations that lending firms have when making a yes or no decision on a project or even on an individual borrower, which can be a really helpful perspective to have if you decide to transition to the principal side of the business in the future and want to get your deals financed at advantageous terms. However, where a lot of people find lending roles tend to come up short is the lack of depth as far as what you'll learn about commercial property operations, including things like construction management and commercial leasing, but also things like business plan execution, contract negotiation, and general value creation strategies used in the industry overall. Most debt side roles also won't include in-depth analysis of partnership structures or negotiations with equity partners, which can leave a really big gap in your skill set if this is something you plan to do later on in your career. Many lending professionals can also end up with relatively limited financial modeling skills, since most analytical work often involves reviewing a borrower's model that's already built out, or using your own basic underwriting model, primarily to make sure that a deal is going to meet certain debt service coverage ratio requirements, debt yield, or loan to cost requirements. But you usually won't be taking a deep dive into the IRR, the equity multiple, or the cash on cash of a project unless you're working for a debt fund in an alternative lending position. And because of this, many investment and development firms will look at debt professionals that have spent more than about 3 years on the lending side of the industry and start to question their underwriting or financial modeling abilities in general that tend to be necessary as you move into more senior level roles in acquisitions, asset management, or even portfolio management, which can result in some real estate professionals finding themselves pigeonholed in lending after starting out on the debt side of the business. Ultimately, the debt side could be a great fit if you want exposure to multiple different product types, you want a job with inherently lower levels of volatility, and you want to focus most on the finance aspects of commercial real estate and don't want to get involved with the hands-on blocking and tackling related to property operations, but you might want to steer clear of lending roles if you want to learn more about raising equity capital, want to become an expert in real estate financial modeling, and you're looking for significant income potential and you're willing to deal with the risks associated with that upside. Either of these paths can give you valuable experience to take with you regardless of where you end up, but I hope this is helpful to go into the job search a little bit more intentionally as you're planning out next steps and selecting the types of jobs that you want to target. And if you want to make sure you have the skills you'll need to get hired for analyst or associate roles at top real estate investment, development, or lending firms across the industry, as always, make sure to check out our all-in-one membership training platform, Breaking into CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification Exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on this channel on the pros and cons of different parts of the business, make sure to hit the like button and let me know. And let me know in the comments if you're more interested in the debt or equity side of the industry and why that's the case. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.